The Federal Reserve had to create more liquidity or try to do that. It doesn't really matter if people still act on it. By definition, the worse the economy gets, the higher the stock market goes. The government accumulated $5 trillion in debt. We have grown up with this belief, rightfully so, that the stock market is a reflection of the economy. Because the economy is basically the health of the businesses, and the stock market is listings of or equities of the business. So it assumes if the economy is doing well, the businesses are doing well, therefore the stock market's doing well. And then we see it in reverse order. If the stock market is doing well, we think the businesses are doing well, therefore the economy is doing well, right? But what happened, the Fed started to come in and manipulate things, and we had more of a financialization of the actual economy itself. And so the economy became more and more reliant upon asset prices. So the Federal Reserve had to create more liquidity or try to do that. Now, there's an argument as to whether or not they can do it directly or they can only do it indirectly. But the bottom line is it would create more liquidity or more money going into the stock market. So even if the businesses in the stock market are going bust, as long as there's more money flowing into the stock market, perversely enough, the prices of those stocks will continue to go up. But here we have an interesting supply-demand dynamic in the actual stocks themselves. So I'm sure a lot of your listeners over the past few years have been hearing about corporate buybacks. All these corporations, they're taking out, they're borrowing money or they're taking all of their profits and they're not investing it back into the business, creating jobs, creating manufacturing, investing in plants and more goods and services. They're just buying their own shares back. Well, what does that do? That reduces the amount of shares outstanding that are available to buy. And then if the Fed comes in and does quantitative easing 1, 2, 3, 4, infinity, and their balance sheet goes through the roof, well, now the capacity of the commercial banks, their balance sheet capacity, in other words, their ability to create more and more loans, that increases, and they see the real economy as, well, I don't really want to touch that with a 10-foot pole. From a risk reward standpoint, it doesn't make a lot of sense to lend someone $1 billion to start a factory, let's say, in California, where we know the business environment is very unfriendly, taxes are most likely going up. So risk reward, that doesn't make sense, where we could use that balance sheet capacity to maybe lend money to a hedge fund or a financial institution, and they can go and into the stock market, drive stock prices higher, and we know we have less downside because there's a Fed put. The Fed has their back, so to speak, because the Fed, now whether this is real or just psychological, it doesn't really matter if people still act on it. They believe that the Fed won't let the stock market go down, therefore these banks see that as better risk reward, that meaning lending to hedge funds that are going to go in and buy stocks, bonds, create derivatives. The bottom line is financialize the economy even more than it was before. So my whole point is there's a huge disconnect between the stock market and the real economy, to the point where I would argue there's even an inverse relationship. So the worse the economy does, the better the stock market does, because the Fed will come in, increase the size of their balance sheet, create trillions of dollars worth of bank reserves, expand the balance sheet capacity, and that means more, potentially, or most likely, more capital flowing into the stock market, even though unemployment goes to 15%, 20%, 30%. It's just the more unemployment we have, the more quote unquote money printing we get. And if the stock market goes up due to money printing, then by definition, the worse the economy gets, the higher the stock market goes. The deficit spending of the government right now is being monetized by the Fed. And that just means that the government is issuing debt, let's say for a stimulus package, and they're basically in a roundabout way, selling it directly to the Federal Reserve. The Federal Reserve is creating more bank reserves, and that's what the government is using to back up the checks they're sending to, into the real economy, to the average Joe or the business for PPP or whatever it is, however they're getting that stimulus out there in the past and in the future. So they're monetizing the debt. That is debt that has to be a part of deficit spending, or they wouldn't need to, if they're just generating that money through taxes, then they wouldn't need to issue the bonds. So my point there is this year alone, the deficit or the increase in debt is about $5 trillion, the federal government debt. So why is that a big deal? From 1776 to 1996, the government accumulates, that's 220 years of the initial existence of our country. Own asset prices or don't own assets now, it gets harder and harder for them to buy assets because they're going up in price. There is no free lunch. That's the bottom line.